In this section of chapter 10, we begin the equity markets, which is why we have investors or institutional or individual investors, and also why corporations buy back their own shares. No? So we will see in chapter 10 how is an IPO, and then why companies issue new money. On the next one, we try to see what how to value stocks, and then how to do stock trading. No, so the beginning is many companies begin usually as private, no, so they are just owned by a few people, and then they eventually, as they grow, they decide to go public. So most corporations are, or most companies are private. We have a few that they become public, and then we will see the IPO process of going public. What has been the trend recently has been for companies to remain private for longer time, because there is plenty of capital to support their initial growth stage. So we see many, especially in the software, in the knowledge sector, that they remain private for longer than in the past. So many also well-known firms are deciding to remain. Usually they were public, and then they decided to go private. Many times the main rationale for staying private or going private is to make changes. No? So usually the stock market is so focused on the short term that doesn't allow the owners or the management to make big changes. Therefore, they may decide to take the company from being public to take it private again, and then once it's private, they can do the overall changes in the focus of the company, and then eventually turn around. Rackspace from San Antonio did that, and they were public, they were private, then they went public. The company decided to change course, so they went private again. And finally, after a turnaround process in a couple of years, they decided to go public again, no? and be open and more subject to scrutiny, because all the information now is more publicly available. So one of the difficulties of being private is to obtain financing. No? However, we see that quite often as the company grows, the original owners wants to cash out. That's their idea: is I want to be a little bit more as owner. I want to be more diversified. So I'm not going to own 100% of the company. I'm going to be partially owner. Maybe usually the founders remain in charge of the company, but they have a lower portion of the company, and they sell out. So the idea is usually the company has to be large enough to justify, because going public, it's a long process. We see that the venture capital firms allow startups to continue to remain private. They usually invest in the earlier stages. They invest in so many companies at the same time, and then eventually one of them, if it turns out to be a great investment, it over compensates for all the other companies that didn't take off. So usually you have many venture capital firms competing in the early stages for the next big thing, and if they are successful, they can make a lot in just one investment. So there's no guarantee that every investment they make will be successful, but they tend to concentrate. So you see that the software industry was heavily concentrated in the Silicon Valley area, San Francisco. So that's where most people mingle, and then all the venture capitalists also are located there in that area. So we tend to see that venture capitalists tend to flock in a particular industry in a very close physical location. No? So usually they try to sell after a couple of years, and then with the proceeds enough to cover all the initial investments and more. So they will try to continue investment in this. Quite often, what happened to Rackspace was that the company needed to be doing a turnaround, and there was a private company that bought them and issued a lot of debt to finance their. So they do usually a leverage buyout, LBOs, What they did, the idea was, once we have this so much debt, we're going to use it to buy the existing shareholders. So now we own the whole company, and then we can do the transformation process and eventually sell it in a couple of years later. Okay, so that's the difference between private equity and venture capitalists. In the end, these venture capitalists are in the early stages. Private equity, what they tend to do is, once the company is public, they will try to buy them because they see value in it, and they try to sell them later. So many of the well-known companies have been going through this process now. So in the initial stages, usually funded by venture capitalists. In the transformation process, like Staples at one point was public, then it had to transform after going bankrupt, was bought out by a private equity fund. They transformed the company and eventually took off. No? So the companies go public when they change they cash out the owners. So they now have more owners that are more diversified, and the company also increases equity. So they have more equity, a little bit less debt than before, and also the creation of a secondary market allows those who own shares to just change its ownership, sell and buy if they see value in it. So it's a very flexible, and allows to know exactly what the stock price is for a predetermined company. No? So the idea is, those who want to save, they can buy stocks. Those who need the funding, they can sell stocks, and then that flow of funds is facilitated thanks to the public market. Usually one share gives the right to one vote. Normally, small investors do not directly vote. They just assign a proxy, or they side with management on whenever there's a voting. This is for common stock, but there is also preferred stock. So preferred stock is the same ownership, but it's a hybrid between a common stock, or between equity and debt, because they pay dividends. And one of the characteristics of this preferred is that it is a little bit less risky than common stock, but more risky than debt. There is a cumulative provision saying that any dividends cannot be paid to common stock unless the preferred received their dividends before. So they have a preference over the common stocks. And dividends are not tax deductible. So in this sense, bonds are better for the company because the interest expense is a tax deductible. However, they also represent ownership in shares, and sometimes it's better. They may have a more say, or usually is assigned to those investors that really want to have a say in how the company will do. So maybe sit in the board and so on. So they can have multiple voting rights, preferred shareholders, and so on. So we know that stock prices, once the company is public, the information is constantly flowing into the market, and the information is not just information that goes from related to the company itself, but it can be also about the economy, about the industry, so there are many things that can make. So many times we don't know why investors may decide to sell. Sometimes they need the money, but sometimes they don't see much value in the company anymore, so they may decide to sell, and that decision always finds a counterparty, somebody that sees value, and that makes the price change. No? So we have many participants in the stock market, and many corporations may sell to increase and continue to invest, or to use that as they may sell shares to pay trying to give their stock options to employees, and all those who actually work in the company, and then they receive compensation. As part of the compensation package is also included shares of the companies. So quite often the company needs to issue new shares to account for that compensation its employees. We will do one activity on how the process of going public is. We have many companies that are going public, even though it's not as popular as it was before, but the process can take a couple of months for this, and then it can be expensive. So quite often the most difficult challenging part is to find what would be the stock price, because there's something new about the company. Nobody knows what the true price of the company should be. So what the IPO process does, through the investment banker, they go in a book building process trying to find where would be demand. So it goes to prospective customers saying, okay, at this price, how many shares are you willing to buy, and so on. So it tries to do a book building saying, okay, we think that the price of the IPO should be between the range of 10 to 13 to maximize participation. We're going to sell X number of shares, and then we will raise 44 million. So if you see at 11, this should be the best possible pricing at this point for the company, because more money will flow to the issuer. But that's the process that is done for each IPO, and it's usually the investment banker that will go through this process. And the idea is to assure price stability. So once the company goes public, then the price will go and be around, or even slightly higher than around $11, if that's the IPO price. And they usually have a lockup period saying no new investors who participate in the IPO cannot sell their shares before X number of times. Usually 6 months. No? So Google was so well known that they did a Dutch auction, which is a very uncommon. They had a goal of selling X number of shares, and what they did is they started with the high price. Dutch auctions are the opposite of the auctions that we are used to. So in a Dutch auction, you start with a high price, and then you start lowering until you finally satisfy the number of shares that they wanted to sell in this case. So Google is different in the sense that they were able to do that and bypass the IPO process because they were so well known. But most IPOs are for companies that are lesser known, so they don't have that luxury. So there are some potential abuses in the IPO market, and charging high commissions, and then lettering by saying, okay, we're going to beat up the price so we have a big jump in the first day, and then IPOs that you give some preference to some customers or not. There is no guarantee that IPOs will pop in the first day. So we tend to focus on those who jump by 30-40% on the first day of trading. So that means there was money left at the table, or that the investment banker underpriced the issuance. But many do not change significantly during the first day of trading. One of the things to consider is also during an IPO that quite often the company is lesser known, therefore their prices will not change by a lot. So there are also secondary stock offerings. So when a company that is already public, they do another issuance of shares. This is usually perceived as a bad thing for companies, because the stock price will drop, because suddenly you have more supply of shares. No? So what's been going on lately has been this thing here, is that companies are buying back their own shares. That is really has been increasing by a lot, and that's been the trend. The idea is that quite often insiders will know more than outsiders. Therefore, the company owners may see that the share price are undervalued, and they buy back their own shares. What has been the case is many times companies buy back their own shares in order to distribute this as compensation, part of the compensation package. No? So we don't know whether the company is overpaying or not, but usually when insiders buy back their own shares, that can be seen as something good. No? So we have organized changes, and the most famous one is the New York Stock Exchange, but in the US we have like 8 or 9 that are smaller ones. The 3 major ones are New York Stock Exchange, Nasdaq, which is an electronic stock exchange. So there's no physical place. In this one, the New York Stock Exchange is the one that you see the trading floor. That's the one you're probably more familiar with. We have some that in the past used to yell at and used to ask for prices and so on. Some specialize in certain number of shares and they make market for shares. So they, when there's nobody willing to buy, they can buy on their own, just to keep an order flow. So companies need to comply with some listing requirements. This is Nasdaq or all the usually the .com or the software companies, they tend to be listed here. And then we also have OTC, over-the-counter markets. These are riskier and less transparent as the other ones. Usually penny stocks trade here because their share price is less than $1. So to trade on Nasdaq and New York Stock Exchange, usually the price has to be longer than $1 per share. No? And when the company is not trading at that value, they are usually delisted or they list in the OTC markets. And this is also even for smaller trades. This is less transparent, very, very, very risky, and can be subject to many scams. No? So I think now scammers have moved to the crypto arena, so you don't see that as many scams in the pink sheets as before, but it can be dangerous as well. No? It can be. So well, we know that liquidity, this is the stock price. Usually we see, let me show you one in Yahoo Finance. Let's say, for instance, McDonald's. So we see that McDonald's is trading at, this is a per share price. So if you want to buy one share of McDonald's, you pay $211. Usually shares are sold in round lots. So you will be paying, you will be needing 100 times 211, so $21,000 will buy you one round lot of McDonald's. Now brokers allow you to buy fractional shares, so it's no longer need to own that much money, no, as before. But this is the previous close, the open. This is the bid ask, and you can see here that McDonald's trades in the New York Stock Exchange and Nasdaq as well. So this is the bid and the ask price. So if you want to buy, this is the price. This is if you want to sell, this is the price. This is the today's range, and this is in the last year of trading. This has been the range for McDonald's. So it went as up as 231 per share and as down as 124. So it's a wide range. How many shares are being traded today? On average, you have a 2.7 million shares that trade daily, no, on any trading day, which implies that is a lot of interest in these shares. So we see many people and investors not having different views about the company. And we see that they pay $5.16 in dividends or per share, or a 2.4%. That's their dividend yield. No? So you divide 516 divided by the price of 212, that should be around 2.4%. The earnings per share, this is a measure of how much the company's earnings earning for one share. And this is the price earnings ratio, which can be used as a measure of how much are you willing to pay for $1 of earnings in the company. And this is if you want to multiply the number of shares outstanding times its price. The McDonald's is worth today about $157 billion. And the beta is how risky is the company as compared to the overall market. So a beta of more than 1 means it's riskier than the market. Beta of less than 1, as is in this case, this is a defensive stock, or meaning when the market drops by 1%, on average, McDonald's should drop by less than, or by about 0.67%. Or when the market goes up by 1%, also their shares will go by less than 1%, by 0.67%. So it's going to be a little bit less volatile than the overall market, which is good for when things are bad, no? When you're playing defensive. So this is kind of what we can see here in any quotation, volume, and number of shares. And this is what we observe as today for McDonald's. Then we can see information about companies in many places. We have analysts, and this is what they estimate what the stock price will be. Always is just an opinion, so we're not sure. Let's say on average estimates for analysts on Microsoft on McDonald's shares are 236, but that's no guarantee. No, it's just an opinion. And you see, for any opinion, you will have the opposite. So you can always make an argument in favor or against. So we have some sell analysts, those that give you list of securities to purchase, and there are some that just give their opinion. And usually when they publicize something, you should be aware that you don't know what their position is. So maybe I'm saying nice things about the company, and you never know whether it's because I really like the company or because I want to sell, and I talk nice things so I can find somebody to buy it. No, so it's hard to know what's the intent of the company, of the analyst. They try to be as impartial as possible, but really you can, it's hard to tell. No, why would somebody would be recommending a particular company? You never know. So it's always good to know what they have to say, but then don't act on whatever they say, because that's, again, you don't know what's there. So there has been some irregularities on accounting. So now Sarbanes-Oxley made the CFO and the CEO personally liable for any misrepresentations in their financial statements. So they can go to jail if they lie on their financials. And it increased the cost of compliance by firms. So many firms, some of them decided to go private because there's a lot of paperwork that needs to be filled out, but to comply with Sarbanes-Oxley. So it can be bad at times. There was the belief that many companies would delist. In that fear never materialized. So we have also some shareholders who own a significant size of the company. Sometimes wants management change, and they may decide to engage in some kind of activism. No, saying, okay, let's go and move, try to pass some motions to improve management or to change the course of where the company is going and so on. So these are the options that we as investors have. Is usually do nothing and just keep their shares passively, or if we don't like something, we can sell the stock, or we can engage in activism to try to change things. No, so those are some of the ways. The governance sometimes is not as efficient as or effective as some people would like. So there is some power of governance, meaning that shareholders can usually promote change within the company, but usually if you have a big dominant shareholder, then it's very likely that nothing will happen. No? So many companies have been doing leverage buyouts, so using debt secured with the assets of the company to buy the company and take it private. And other companies have decided to pass anti-takeover amendments, saying we are going to try to fight our way not to be bought out by another company. Okay, so this is usually perceived as something bad by the market, because that assumes that these are things that the management does to entrench themselves. So if you are more secure, or if you have too much job security, then you probably are going to not perform at your best, because we need some kind of fear at times to do better, no? Or to try to keep that sense of urgency from. And if management feels too comfortable, then maybe change will never happen in the firm. And then when companies are, there is a information provider that they qualify, they say, okay, these are the companies that have the most barriers to corporate controls. So they do a scorecard, and usually you see the companies that don't do really well, they tend to have very bad corporate governance rules. So they tend to have these anti-takeover amendments, poison pills, or golden parachutes, and so on. So we see that now we can invest in any markets anywhere. If we like Chinese companies, you can buy them through an ADR. If you like companies from different parts of the country, from different industries, so it's a very easy to be diversified these days. And we in the U.S., most of us will use ADRs, no. And so these are just, we buy certificates of shares that are trading in foreign markets, but you can buy them in the U.S. using U.S. dollars with your local broker, so you don't have any risks of investing in a foreign market, because this is invested using U.S. trade law and so on. So it's very easy to be well diversified internationally. And you have also many ETFs that track international funds. So there's no reason now not to be internationally diversified in our holdings. So this is a very short introduction to our chapter 10, and then we will be talking next week about chapter 11 on stocks.